What does value add actually mean when you're referring to multifamily real estate? Well, in today's video, I'm gonna break it down for you so that you can know in less than 60 seconds whether or not there is truly a value add component to the asset that you're looking at. And in context, value add is just a term that identifies the ability and the opportunity to increase an asset's value because it's not performing at its peak performance level, which is typically referred to as the stabilized value. Stabilized value just means that it's operating just like it should be. The market rents are where they should be, the expenses are typically where they should be, and there's no real value add component, and you're just gonna own that asset long term while it continues to appreciate and pay down the mortgage and spit off the cash flow at whatever rate it does. The problem is that everybody likes to use the buzzword value add, especially brokers in all of the listings where there is a little bit of opportunity in an asset because they know that that's what people are looking for. And the issue when buyers are looking at that stuff is that they think that they can just go into an asset and do some renovations and then magically the asset is going to increase in value. And that's just not how it works if you're not basing it on a few fundamentals. And that's exactly what I'm going to break down for you today. And we're going to talk about the three core fundamental aspects to any value add component. My name is Bouchard, and I have bought many apartment buildings and renovated hundreds of units in one of the toughest and most expensive markets in North America. And by doing so, I have generated over $25 million of equity for my partners and my investors through the strategies that I'm going to share with you today. What does it actually mean to me? What does value add mean to me? Well, ever since I have started in business and/or in real estate, all I've ever looked for is the ability to add value to the situation or to whatever I'm touching or doing. And I think that that's just a typical way of approaching business. Because if you're not looking at it from a way of how can I add value, then you're just buying something for what it's worth, and then you're just waiting for it to appreciate. I'm just not that kind of guy. I want to force the appreciation. I want to be active in the appreciation of an asset by making it better than it was when I found it. And that's what real estate acquisitions mean to me when I'm talking about value add components in multifamily real estate. It's buying something that has the opportunity to increase itself in value, and through the strategies that I implement, I'm able to perpetuate that momentum and accelerate it to get me there faster and to get it to a place where it has created wealth out of thin air. So if you're new here, I help investors and professionals create real wealth through multifamily strategies. And the three core aspects to value add components to the strategies that we use are making the asset more appealing and fixing the problems, increasing the income, and decreasing the expenses. Those are the three things that we're going to break down today. So first, what does actually making something better mean? Well, the first thing that I look at when I'm going into an asset, or I'm going to look at an asset, is I just look at what is wrong with it. What are the issues that are very obvious to me without actually looking at the numbers? And when you're looking at a multifamily building, you're looking for distress. You're looking for something that needs work. So you're looking for the exterior, capital expenditures like, the paint, the roof, the doors, the windows, the interior, the common areas. What does it look like? What kind of feeling does it give you when you walk into it? Does it make you feel like it's a place that you would want your family living? That's really the litmus test. It's like, would I put my own family in this building? And if the answer is no, then that usually means that there's a value add component right off the bat. And then it's just up to you to figure out exactly what that means. And that's going into the units and looking at the condition of the actual living conditions of the tenants that are going to be in there, looking at it through your own eyes. What would be the conditions that would make me want to pay full value and full pop for this asset? And then beyond that, you're going to be looking for the management. Right? How is the management? What is their advertising like? What are they doing to attract tenants? Is the management even good? Are they responsive? Do they get compliments or do they get complaints? Is there someone living in the building? Is there someone that's actually there helping people when they have issues and resolving them very, very quickly? Or are the tenants really upset and they're distressed and they don't want to be there themselves? And in a lot of situations, I find buildings that people don't want to be in, and they're living in conditions that they're not even happy with. And they express that to me openly, that they wish that they could have a better life and a better environment. But the reality is, for most of those situations, the reason that they're living in those conditions and putting themselves through that is because they're paying well below market rents. And then that's the trade-off that they have to live in. They have to trade their stress and their environment and their willingness to live in a standard well below what they want to, all because they need to save a few bucks on their rent. Well, I like to go in and create strategies that not only just evict the tenants and get them out and then renovate to the full standard and then get new people in that are double the income. In some times that's avoidable depending on the condition, but my favorite thing to do is to actually talk to the tenants and try and work with them on a plan that incorporates their ability to live in a better environment and do minor upgrades and minor modifications along the way that they can actually participate in by increasing their rent slowly over time. And in a lot of cases, what I've done in apartment buildings is I've actually negotiated with the tenants in the building. And that's what brings me the most joy in those situations, because I'm actually able to talk to them about what they're willing and able to do and contribute from a rental standpoint, so that I can then do the math on that and then turn that into money that I'm able to give back to them by way of renovating into the units and into their living conditions, which ultimately helps me improve the overall quality of the building. And these are all things that I look to identify when I'm walking into a building. And you look at the plumbing, you look at the electrical, but all of the stuff behind the walls is just a deep dive into the inspection that you don't really need to get into. You can typically tell just by walking into any asset exactly what kind of feeling you get from it, and whether or not there's water leaking out, or there's cracks in the ceilings, or there's air blowing through the single pane windows, and there's people in the conditions they're in, et cetera, et cetera. You guys get the point. But when I go in and I look at, the very first thing I want to do is I want to look at how can I improve the quality of this asset right off the bat to attract better people and better clientele that are willing to pay more to be in that space. Because at the end of the day, the asset's value is tied to the income that it generates. It's as simple as that. And if we can work with the people in the building, great. And sometimes we can, and sometimes we can't. But the reality is, if we're not able to generate more income from the asset, then we're limited to how much money we're able to put into it. Otherwise, we're just operating a business at a loss, and we're just not in it for that. So, lesson number 2, and pretty much the most important fact, is how can I increase the income to the asset? So that's what I wanted to show you today. So quick math on it is, let's say I have this apartment building, okay? Here's apartment building right now, boopity-boo. I know this looks like a house. I don't know how to make it look like an apartment building, but just imagine it's apartment building, okay? Let's just add a little square on there. There we go. That's a little better. All right. Boom, bada boom. Let's just say that this is a 20-unit building, okay? Nice and simple. And let's say the current rents, are 20 at, I'm gonna call it $1,000 a month. Now, when I started renovating apartment buildings and buying and renovating apartment buildings, we were looking at buildings where the rents were sometimes $400, $500, $600. That world just doesn't really exist anymore. Now you're looking at buildings, tired assets are typically in the $600, $700, $800, $900 range, depends on what market you're in. And I'm generalizing there, but I'm getting distracted. So 20 units at $1,000 a month is $20K a month, okay? 20K times 12 equals 240,000. 240K a year, okay? Now this is just the income side, so we're gonna just use a general 50% right now. So let's just use an approximate 50% expense ratio. So you take 240K and you times that by 50%, and you get 120,000 NOI, which is called the net operating income. The net operating income means that you, after collecting all of the rent and paying all of the expenses of 50%, which include your taxes, your insurance, your maintenance, your management, your utilities, and your buffer, and your legal, and your accounting, and all that fun stuff, you are left with $120,000 a year. Now, you take that $120,000, and let's just say, easy math, you're in a 10% cap rate market. You divide that by 10% cap. That equals a $1.2 million value on that building, okay? And if you don't know what NOI and what cap rate are, I've done a video on that. You can go and find it. It's going to be called Cap Rates and NOIs, or How to Value a Building, something along those lines. Those are critical components for you to understand when you're talking about multifamily. Most people in the business know what it means, but I understand that some of you may be watching this and don't actually know what that means. But it's kind of irrelevant right now. Just take my word for it. 10% cap rate is basically how you're just valuing the area. That tells you how much money you're making from the asset, and then you divide the cap rate by how much money it's making, and that gives you the value. And you can use all three of those values and play with them to reverse engineer it. Okay, so I look at this building and I say, okay, I've got a 20-unit building, and this is how much it's making, and it's collecting $1,000 a month, right? Now, we take this same building. I'm gonna try and make it look more like an apartment building this time. Maybe that's part of the value add strategy. Who knows? Okay, bobbity bobbity boop. You've got windows, you've got a thing, you've got a place, and holy crap, you've spent some money on this asset. Maybe you give it a flat roof. Maybe you change the roof. Who knows? Oh yeah, that looks, oh yeah, now we're talking apartment building, hey? Same 20-unit building, right? So it's still 20 units. But let's say that we've renovated this, okay? And I'll do a bit of the math on the renovation. But for argument's sake, let's just say that this building needed very little work, but it was just lower on the rents. And it was in an actual market that was paying $1,500 for the same units, all right? So that means that the value add component on this was just simply that the rents were well below market value, that we were able to buy an asset that didn't really need much work, and we can increase the rents, whether it's right away or over time, up to $1,500 a month. All right, so what you do is you take 20 units, and you times that by $1,500 a month, right? 1,500, I shouldn't have to do this math, but I'm going to anyways. I'm going to take 20 times it by 1,500. That's going to give me 30,000. I definitely shouldn't have had to use a calculator for that, but that's okay. Equals 30K a month now, right? So now you take 30K per month, and you times that by 12, and you get 360. I'm sorry I'm messing this up here, but $360,000 annual, right? Now we're gonna take the same 50% expense ratio, and we're gonna go 360, and we're gonna times that by 50% expense, and that's gonna give us $180,000, okay? You guys like how I didn't have to use my calculator for those ones? Pretty sweet, eh? So $180,000 now, and you're gonna divide that by the same 10% cap rate. And if you take your calculator and you literally take $120,000, which is the net operating income, and you divide it by 10%, which is how the banks would value, which is how anybody would value the asset. Not the cap rate does change, but I'll explain that, like I said, in another video. But you take it by the same 10% cap rate, and now your building is worth $1.8 million. That's it. That's exactly how I would look at what kind of income is missing from the pro forma to allow me to get a bit of a value add component. So this might look complicated, but it doesn't. all I would do really is I would just look at the building really quickly and I would say, okay, 20 units, renting at $1,000 a month? Really? When the market is 1,500, okay, perfect. What I'll do is I'll take the spread. I'll take $500. I'll take 500 and I'll times that by 20. And that's going to equal $60,000. And that $60,000 is the additional rent that I'm going to be able to increase. And it just kind of saves you from doing the rest of the math. And did I actually do that right? Let me just make sure here. Right? 500, what am I doing here? 500 times 20. No, oh, that's right. Okay. It's 120K per year. I was just doing it too quickly in my head. Divided by the 50% expense ratio that I would always apply just as an average number. And then I'm going to get $60,000 a year. So that divided by a 10 cap equals $600,000 of increased value. That's how I would do that on a napkin. This is just the short version of doing this. Where is it at? Where is it going to be? And what's the difference? That's adding the income. You have to know that because you have to know what the maximum amount of rent you're going to be able to achieve is no matter how much work. That's before I even think about the renovations. Because now I know how much money I have in order to afford to do the work to the building. So if someone comes to me and tries to sell me a 20-unit building and they say, Gee, it's got a value add component, like it's huge. The rents can be increased from $1,000 to $1,500 a month. It's a ridiculous deal. You can increase the value by 600 grand just by doing a little bit of work to the building and doing the management to increase or to get new tenants in. And then you look deeper into this building and it is so bad, it is in such bad condition that it requires $600,000 worth of work to get it from this condition to this condition. Does it still seem like a good deal? So you're telling me I have to buy an apartment building that is, yes, under market value, but I have to spend $600,000. I have to do all of the work, put in all of the time and all of the effort to manage it and turn over the tenants and do the construction and take the risk just so at the end of the day, I can break even on the value? Why would I do that? Why wouldn't I just buy a building that's already done and just collect the same amount of money from day one with none of that headache? And this is a more complicated aspect, which we're not really breaking down in it. Maybe I'll do a little bit on it, but that's the general way to look at the income that you're able to increase. Okay? Understand? So that's the napkin math. What is it renting for currently and what can it rent for? And if those numbers don't check out, you're done. There's nothing more to look at on the deal. Don't spend your time going to look at it. Don't spend your time doing a tour. Don't call your friends and don't call your contractors and just kill it. Done. Over. Move to the next one. Okay? Lesson number 3, the expenses. Okay, so we talked about, lesson number 1, we talked about just the overall. So like, look at this building right here, right? It's kind of derelict, looks kind of crappy. There's a lot of things that can be cleaned up, probably smells. Maybe the units need some renovations. And then you see in your mind, if I just did a little bit of work to this building or lot, whatever it is, I can make it look like this. That's the very first thing you want to do. What is the aesthetic and managerial approach that you can take to increase the perceived value and attract more of the people that you want that are going to be willing to pay more? The second lesson was talking about the income. What is it currently bringing in? And what is it going to bring in once I'm done doing the work or it's at market level? And that's, 2 components. One is, what is just the market willing to pay for a similar unit? And what is the work that I have to do in order to get it there, okay? So now we're going to talk about lesson 3, which is the expenses. So you remember in lesson 2 when we used a 50% expense ratio? That's a very, very general, fast way of doing the quick math without having, or to find out whether or not it's even worth diving in a little deeper. But let's break down that 50% expense ratio, okay? So the 50% expenses comes from taxes, insurance, maintenance, management, utilities, so services, TIMS is a pretty common name for all of it because it captures it, right? When people say TIMS, what are the TIMS? Taxes, insurance, maintenance, management. I call it services. Some people call it stuff because it does include a whole bunch of stuff. But services is like the utilities. Who's paying the utilities? That's a big aspect. There is contingencies and legal and accounting and a whole bunch of stuff. But the banks and buyers, they only look at this stuff because these are non-negotiables. You're paying this stuff no matter what. All the other stuff is subjective. You can do the other stuff yourself, or you can pay other people to do it. It's not really relevant to every buyer. This stuff absolutely is. So when we did the math on the last building, it was 240K at 50%. 240K, 50, so that's 120K NOI, but that was 50% expenses as well, right? So if you take, again, for easy math, which I'm not sure if I'm gonna get myself on easy math here. This isn't really how it works, but it's a good one to do. Let's just take 120 and divide it by 5, okay? So let's spread the expenses out evenly over all of this. So the taxes are 24K, the insurance is 24K, the maintenance is 24K, the management is 24K, the utilities or services is 24K. And it's actually very close to this. When you're actually looking at buildings, you're gonna find some really common numbers that are gonna show you that there's an approximate percentage to most of this. And so you take these expenses. Now, forget the income. We're just talking about the expenses. Now, if you look at this building and you take a look and you're like, these guys are whack. Like, I know the area. I've done the research. All the other buildings that I'm looking at are nowhere near these expenses. Like, what if 50% is really high? Like, why are they operating at a 50% expense ratio? 50% isn't really high, I'll tell you that. Anything over 50% is usually pretty high. Sometimes it's related to the rents being so low that the expenses are just, they seem high, but I digress. Let's not confuse the point. Let's just say that you knew that you could come in here and you could decrease the expenses, that you know that you could pay less taxes. Now, again, maybe you can't pay less taxes, but I don't want you to get into the weeds on this. I just want you to follow me. But let's say that you were actually able to save, I don't know, 15%. Actually, we're just gonna do easy math. 10% on everything, okay? 10%. Just by better management and better maintenance, and you had better deal on insurance, maybe the old thing, the utilities, maybe you pass some of those off to the tenants. Okay, so that's 2.4K per. Just by better management. So 2.4, 2.4, 2.4, for a total of 2.4 times 5 equals $12,000 in savings. What you're doing is you're just looking at ways for you to be able to take their financials and see, are there things that I know that I could do immediately to improve the bottom line by reducing the overall expenses? And in this assumption, we're gonna say, yes, I can definitely lower the expenses by $12,000, okay? So that means what you're actually doing is you're going to add $12,000 of savings back onto the NOI. So that means that the expenses, they actually go down by, I'm gonna reverse engineer this here, but you take 120, which is your existing expenses, and you subtract 12, and you're left with 108. So over here, you're going to have 108 expenses, which from 108, you subtract that from the 240 is a 132 NOI, but you basically take this, so you're going to go 132, you're going to go 240, 132 divided by 240 is actually a 45%. That's 45% expenses. So what you've done effectively by reducing the expenses by 12,000 is you've gone from 50% expense ratio to 45. That's it. Just from changing that. You haven't changed the income. You haven't really done any work to the building. You've just been able to lower that. And for those of you, actually, this is the expense ratio, but 45% expense ratio is actually what you want to actually do is you want to add this to the NOI. So on the flip side of when you're calculating the value, you actually want to take that 12K and then you add it to your NOI. And if you recall, the NOI was the money that was left over after you paid the expenses, right? So what you wanted to actually do is you want to take 240 and you times that by 55%, times that by 55%, because that's going to be your NOI calculation. And you're going to get $132,000 in your pocket instead of the original 120. I know I'm playing around with income and expenses here a little bit, but I hope you're following me. And if you recall, the next step that you do is you take the NOI, 132, and you divide that by the 10% cap rate that we're using to value this building. Divide by 10%. Get your handy dandy little calculators out. And this building is now worth $1.32 million instead of the original 120 or $1.2 million that it was worth before you reduced all the expenses. It's just as simple to do that as it is to do the calculation of the increase in income. And if you pair both of those up, if you did both of those things, so if you follow me on, if we tie those two together, so this is a $120,000 of increased value on that building just by reducing the overall expenses by about 10%. And that's not that hard to do when a building is mismanaged or it's old or there's issues with it. Maybe you do have to spend a little money, but usually when you're spending money, you're actually going to be able to reduce it even more. But now let's take this and you actually, where you really start to gain some traction is when you combo those two things together. So now you take it and let's do the math, assuming that you were able to actually increase the rent. So you got 20 units at $1,500 a month, which was what we knew we could increase them to, which, what was that again? 15 times 20 is 30 grand. Again, I shouldn't have had to do that math. Normally, I know what I'm doing there. But hey, don't wanna look silly in front of you guys. I mean, that would be a shame, wouldn't it? $360,000 is the gross revenue of the building. But now, instead of actually taking 50% expenses, we've been able to reduce them. And we're going to be able to do 45%. And 45 is modest. Sometimes you can get it down to 40. And usually when you're actually top-notch management, you can get it down to about 30 to 35. But that's for exceptional experienced operators who know exactly what they're doing once they've fully stabilized a building. So you never want to assume that. So now you take it and you times that. So you subtract 45% expenses, right? The expenses are 45%. You're going to take that and you're going to subtract 45%. And now you're left with $198,000 NOI, net operating income. Now you've taken all three of these things and put them together to assess what you can do with the management and the aesthetics of the building. You have increased the income, you have decreased the expenses, and you are left with a building that is now paying you $198,000 a year before debt. I forgot to mention that, but again, go watch my video on NOIs and cap rates. It'll explain that this number is before you're actually paying your mortgage. But that's how you value the buildings in multifamily real estate. You don't take the mortgage into consideration because everybody has different terms on their mortgage. Can't apply one to the other. 198 divided by what? 10%. You got it. 10% equals $1.98 million for a building that you bought or was worth $1.2 million when we first started doing this exercise. That's an increase of $780,000 from the original value. So this was the original, this is the new. The difference is 780 grand of increased value. This isn't something that I'm making up or that is subjective. This is the math that is actually used by investors and buyers and banks all together, knowing that this is the formula that is going to add $780,000 of value to this asset. Now, once this math pencils and once I know that I've done this napkin math correctly and that I can actually see the upside of $780,000, which by the way is more than 50% increase in value. This is a huge lift if you find a building like this. But the key is now you would look at this number, and now on the fourth lesson that I'm going to teach you, it's how do you know how much it's going to actually cost to get it there? Okay, so that ties us into the last and final lesson of assessing the work that actually needs to be done and actually has an impact on the value. You have to know the difference, you guys. There's work that you can do that's going to make you feel better about your building that isn't going to do anything for the banks, the lenders, or the people that are going to be paying you the rent. The color of the building, for instance, typically isn't going to change a damn thing. The roof, if it's in good enough condition, redoing the roof or redoing the doors and windows when it's just an aesthetics thing for you and it's not really going to change the experience or the life or increase the remaining economic life of the building. Again, another video, remaining economic life is a term used to determine how much life the building has left in it, and that's going to affect your lending terms on it. I digress. But this is a 20-unit building that you're going to have to make those decisions on. Some of those decisions are going to be based on the capital expenditures about what the condition of the building actually is, how it's functioning. Is it falling apart? Is the siding exterior dead? Is it leaking? Is the roof leaking? Are there things that are going to fail in inspection? Those are capital expenditures that you have to take into consideration, because not only are they going to affect the maintenance cost of your building, but they definitely are going to affect the value that the bank is willing to give it, because they're going to give you a loan, an amortized loan, that is typically going to be a maximum of 25 to 30 years, and they're definitely going to be looking at the condition of the building. But if it's fundamentally operating well and there's nothing really wrong with it, and they're going to give you the max term on the loan anyways, there might be limited things that you want to do there. However, it's the condition of the units and the lobby and the experience and the aesthetics that the tenants are going to have that are absolutely going to have an impact on it. And that's going to have an impact. If you're trying to achieve $1,500 rent in a building that's falling apart, and they can go right next door and get a brand new unit for that. Well, what do you think they're going to do? And that's what you're trying to do. You're trying to raise it to a standard that is going to maximize the amount that people are willing to pay without going overboard. And typically, you don't usually want to be pushing to the top of the market either. That's another thing to take into consideration. I used to do things to the absolute maximum to try and attract the best tenants that'll pay the absolute maximum in the units. And that's fantastic in a market where people can afford it. But right now in today's market, that's the last thing on my mind. I'm not going to, spend money on high-end tile and high-end countertops and high-end fixtures and do all of this fancy stuff just to try and squeeze the absolute, like every single dollar I can out of the tenant. Because when people are having a tough time paying rent or getting by day to day, the very first thing they're gonna do is they're gonna change their living conditions and be willing to live with a little less quality of life in exchange for lower rents. So you don't want to be at the bottom. You don't want to be aiming for the very top. You kind of want to be in that sweet spot right in the middle. That'll make sure that you have the least amount of vacancies and you're attracting still very good quality tenants that can pay their rent every single month without issues. So let's just say that you walk in, there's some things you're gonna do to the building. Maybe there's some exterior stuff, there's some lobby, there's some common areas, but the units, they need a total gut, right? So in this, again, broker selling, he comes to you and says, you can raise the rents 500, the value add is exceptional. Why aren't you buying this yet? How come you haven't made us an offer? And every single unit is in the condition that no one would ever pay $1 more for unless you did a full gut on it. Well, I'm not going to use, I'm not going to get into the details of what you could do or how much a full gut's going to cost, but they're typically depending on the market that you're in. A full gut, where I come from in Canada, in one of the toughest and highest and most expensive markets in Vancouver and Vancouver Island, you are paying $50,000 to $60,000 a unit to do a full gut. A lot of areas in the United States that we look at, and of course in South America, there's going to be a lot lower bar or a lot lower cost for doing those, but of course it's all relative to your market. Sometimes the full gut unit can cost you between $15,000 and $20,000. But let's just use easy math. Let's just land somewhere in the middle, okay? Let's just say it's $25,000 per unit for us to go and do the work that's needed on this building. You take 20 units and you times that by $25,000 and you get $500,000. Nice round number, okay? $500,000, and I know that I can take this building and turn it into that, and I can achieve the $1,500 in rent. Before, we had a $1.2 million acquisition price. This was purchase price. Now you would add on the $500,000 for the renos, and you get a total cost of $1.7 million. But we also knew that when you did that work, your building was going to be worth $1.98 million, right? So you've got a $280,000 spread. That is your true upside. That is your value add component. That is the number that you need to be looking at when you're assessing, is this worth spending my time and my money to get to that number? And if the answer to that is yes, then it's worth doing a tour or potentially making an offer and starting to go down the rabbit hole of moving forward on this deal. And you can do all of this very simply and very easily in minutes in most cases. That will save you hours, days, weeks, months of your time, your energy, and all of the money that you would have spent on getting the reports and doing the inspections and going to walk through the building when all you had to do was the simple math to determine whether or not this was a good deal. Because if this all of a sudden goes up to $50,000 and this turns into $1 million, your upside is negative. You're going to put all that time and all that work and all that energy in, and your building is going to be worth less than what you have put into it. And that is not what we're doing this for. And that is not what I would want any of my clients or my friends or my family getting themselves into. So, now that you know the core principles of how the value add actually works and what it actually means when I'm talking about the value add component, I hope you can take this information and apply it to your endeavors to make sure that you are saving time and money and protecting yourself from getting into deals that are just being sold at the future opportunity of stuff that is not real. That's it. That's all. So now that you know what value add actually means and how you can apply it to your business in minutes to save you tons of time, tons of energy, and tons of money as you sift and sort through the deals that are going to work for you, you're already miles ahead of most people that are in this business. You already know that the best way to support me is to like, share, follow, comment, and just follow along on the journey that I'm taking while I help educate people to make a difference in their life. And if you want to know more about how you can get involved, click on the link below and find out how you can live your ultimate real estate lifestyle. Love you guys. See you on the next video.